about 0.25%, 47,990. The IT index is down about 1.3%. So the weaker US data does not help for a globally exposed sector like IT services, and we've seen that last week as well as data soured in the US. The IT index sold off about 7-8%, and this morning it's starting lower. And 3 names in the green and everything else up, everything else down is what you have at this point in time. So becoming a little deeper now, but about 0.5, 0.6% in that range as far as the Nifty index is concerned. Too early, but I mean, for what it's worth, 300 higher and about 1450, 1460 stocks lower. That's the market breadth.
Okay, let's see if the buyers come in at some point in time. Right now, we're dealing with this 140-point cut. So the weakest links are actually everything. ONGC is the one that's down about 3%. A couple of tech stocks are coming off quite a bit. Remember, the Nasdaq fell more than the other indices yesterday. A lot of the chipmaker stocks were down big time. So here, HCL Tech, Infosys, Wipro, Tech Mahindra. IT is leading this decline, this wave down, which is about 2.5% on individual stocks. Coal India is down 1.5%. There is Bajaj Auto, which is lower. Remember, sales were not that great for Hero and Bajaj Auto. We'll be speaking with the management of Bajaj Auto as well in just a bit. Titan's lower by about 1.5%. Tata Steel is on the back foot. BEL, which had a good recovery yesterday, is cooling off this morning, down about 1% or so. Let's see if there's anything on the upside. So some of the banks are beginning to see a little bit of a pullback. ICICI Bank, HDFC Bank, SBI. So there is buying in banks this morning, which is interesting. And a bunch of consumer stocks could be breaking into positive. Look at HUL, ITC. These are some of the early names. Even Tata Consumer. They're still down 0.25% or so. But let's see if there's any traction on the upside. But again, as always, the much bigger problem continues to be the mid-cap part of the market, which is now down 1.5%, Nigel.
Well, let's pull up a few stocks and that are gaining actually. TD Power, we were talking about small chipping in from the promoter. That's something that I observed on TD Power. The stock has seen a sharp correction from the peak. Year to date, it's still down close to around 30%. But the stock is up close to around 8%. So that could be one of the factors at play. That's one of the big movers. Ask Automotive, remember they had announced that they signed a technical assistance and license agreement with Kushu Yanagawa Saiki. So because of that, that stock as well is up close to around 4.5%. So both those two big movers in initial trade. What's losing out? IGI, second day running, the stock is down close to around 10%. Yesterday, remember, the stock was at lower circuit. And, there were pending sell orders as well. So it appears some of those are getting executed in today's trading session. What's outperforming actually in the first few minutes of trade is the Nifty Bank. And that's giving signs that, if we need to fight back, that'll have to perform. Remember, yesterday it was an underperformer. Nifty Bank is almost into the green. It's down less than a 0.1%. So keep an eye out on that particular name. Otherwise, high beta is getting knocked back. Vedanta is pulling back 2.5%. NBFC is down close to around 2.5%. Coffee Day, you're not a stock we track very often, but yesterday as well, the stock was up. It's come off, I think, from the recent peak. Today as well, that one is moving up more than 10% or thereabouts. Not too bad, guys. 150 points down. I think that's par for the course. And 300 stocks advancing. That number needs to get better, though. Nifty Bank putting in a bit of a fight.
Down again, 21,975 is where we are at right now. Just one name, Tata Investment Corporation is up 5% against. It's got some volumes on it as well, about 6,200 rupees on that one. It's like a, it's like a fund basically for the like a mutual fund basically, a holding company with lots of stocks in it, blue chip names, well managed, and they invest Tata's money. Well, Blue Jet is up about 2.25%. MPS, it's got some large individual investors there, 6% higher on MPS, and a few others coming up. GHCL is up about 3%, and far and few in between. Schaeffler is up about 4%. But again, volumes quickly drying up below a certain threshold, below the first 3-4 odd, below the first 6-7 names or so.
Nifty Bank in the green.
Okay, Nifty Bank will come up. Let's put that up.
Yeah,
and that is coming back up a little bit right now. So 10 points or so.
Just wanted to add one more stock. Arvind is seeing a major slash this morning, 9% down on Arvind. Volumes are already beginning to pick up. Now, perhaps this also has to do with the fact that some of these companies are also exporters on the textile side. I don't have the exact numbers in terms of Arvind's export business, but maybe that could be adding to the sentiment downtick. It's down about 9.5%. And IGI, AB Real Estate, by the way, which, yesterday was rallying as we went into close. Again, is a slam dunk on this one, 9%. IGI is the interesting one. We had such a detailed conversation with the management yesterday. They kept maintaining that margins will not be impacted with the lab-grown diamonds, but I think the market's not quite convinced.
20% gone, and of course, it's now, I think, maybe around the issue price, below the issue price, I have to check, but it's a recent listing, essentially. So 330 or so is where we're at. Nilesh Shah is now with us, Managing Director at Kotak Mahindra Asset Management Company. He's our market master of the day. Nilesh bhai, good morning. Good to have you with us here, as always. Prashant this side. Ab kya, Nilesh bhai, is the question. And the other question is, are we there yet in terms of having paid the price for the excesses, etc.? And let's just divide this question in two parts. For the Nifty, which just purely on a PE multiple basis seems to have fallen to averages, and then mid and small caps. Go on, Nilesh bhai.
So Prashant bhai, as of today, it looks like FPIs are aggressively selling. On Friday, net of passive funds buying of about 8,000 crore. The gross sell number was about 20,000 crore. Never stand in front of a running train. If they are selling aggressively, undoubtedly buyers will continue to buy at lower and lower prices. And as long as their selling continues, we think market's unlikely to settle. Buyers will continue to buy at a lower and lower prices. In terms of valuation, now Nifty is trading little below its historical average valuation. This is a fair value market. The excesses of the past has been corrected. And now this is probably time for long-term investors to start accumulating. But keeping in mind, don't stand in front of a running train. In the small and mid caps, again, there is a divergence. Last quarter, mid caps earnings growth was in line with expectation at more than 20%. Small caps degrew by similar amount. And again, it was little below expectation. So within small and mid cap, go for quality, go for reasonable valuation. But do remember that right now the mood of FPI is on the selling side. It is your opportunity to accumulate, not to buy everything today.
Got that. So let's just spend 2 minutes on this FPI bit, right, Nilesh bhai? As you said, aggressive sellers still, and buyers will come in, but at lower and lower levels, right? And there's only limited amount of cash for people who are doing it themselves, who've got systematic investment plans. That's, of course, getting deployed at lower levels, and over the long run, hopefully that will play out. But just your feedback, because you interact with a lot of people in the ecosystem. What is behind this FII selling? And recently, one has picked up another line of argument that, and just a clamor for the government perhaps to look at taxation and things like that, capital gains tax, and how maybe the hike was a mistake, comparison with other countries. I'm sure you would have picked up on all those things. Just wanted your thoughts there.
So one, trying to figure out FPI is like five blind men trying to identify elephant, because there is no one homogeneous set of foreign portfolio investors. The university endowment funds and sovereign wealth funds have been buyer in our market. The long only, the passive, the US-based FPIs, some of the pension and insurance companies have been sellers. So within FPI, not everyone is seller, not everyone is buyer. Now, some of the reasons why FPIs have turned sellers: one, Indian market had expectations built in, and the September GDP growth number, December GDP growth number, as well as quarterly earnings of September 24 and December 24 quarter came below expectation. It couldn't justify those valuations. On top of it, America First, Make America Great Again, resulted into American vacuum cleaner starting, which is collecting money from all the emerging markets. Every emerging market is witnessing outflow, and China hasn't published numbers since October 24. So we don't know whether they are receiving inflows or outflows. But if someone is not publishing number, your guess is likely to be as good as mine. Number three, our rupee also was overvalued. That provided good exit to the FPIs. If I have to sum up, maybe there was a trade where rupee was likely to come down. Indian market was likely to come down. American market was likely to go up. There was a trade waiting to be taken, and FPIs took it. A large part of that is now behind us. But right now, the momentum for FPI is on the selling side. But do remember, they are doing quit emerging market and ghar wapsi to America. And not every FPI is seller. If we look at the data of December 24 quarter, sovereign wealth funds and university endowment funds have been buyers. Yesterday, I was on a panel with Samir Arora, where he said that being an FPI, they have received net inflows for December as well as January month.
That's good to hear.
Just on the other point, second point, do you think this clamor to cut capital gains tax, right? We're all in the market. We all want higher. Everybody wants higher prices, but I mean, the government has got to look at their own thing. Where do you come in this debate? That there is one point of view. As markets correct, everybody becomes more introspective. That maybe this was a self-goal, capital gains tax should not have been touched, etc., etc. Just wanted your thoughts there.
So one, there should be parity. Gujarati mein kahavat hai, garna chokra ghanti charte ne upadhyay ne ato. Our own kids at home are starving and then we welcome visitors. We should not be doing it. Investor is investor, whether it's domestic or global. We should treat them equally. Second thing, just reducing taxes does not guarantee return. What if tomorrow FPIs demand guaranteed return? Will we succumb to it? I don't think so. We should be focused on creating earnings growth and governance. We have delivered better return than all the emerging markets put together. We have delivered better return than China, Brazil, Russia, South Africa. Yes, last 7 months have been bad, but people have made money over here. And on that money, they are paying taxes. So it's not an easy answer. People who are demanding lower taxes for FPIs are probably also demanding stability in taxation policies. Once they know that there is X amount of rate to be paid, they want that to remain constant for a long period of time. So there's no easy answer, but my recommendation will be treat all investors alike, whether it's foreigner or whether it's local.
Okay, that's a very interesting aspect, Nilesh, and brave of you to say that. Usually one would sort of jump to say that yes, cut capital gains tax, but that's not what you're saying. I mean, I get the drift that tax policy cannot move with the swings of the market. Then we'll have to change taxes maybe every 6 months or every year, but there has to be predictability. Take that point, Nilesh. So now come in on the extent of money that you folks have been getting and then putting in the market, and thank God for that, right? Even yesterday, there was buying of almost net buying of 9,000 crores from domestic institutions. We had Ramdev Agarwal on the channel yesterday, and I think he picked up some input saying maybe February the flows would slow down a little bit as eventually people kind of get hit in terms of sentiment. But what's your sense? And with this kind of deployment, because the net deployment on a daily basis has been really huge, with this kind of deployment, what is the net cash level industry-wide when we're talking about Indian mutual funds? And what is the flow situation right now?
So one should be, will flow start slowing down a little bit? Answer is yes. There are experienced investors and there are inexperienced investors. In March 20, when markets corrected very, very sharply, our SIP returns had become negative for 3 years. That did deter some investors and they stopped their SIPs. It also excited some investors and they topped up their SIP. Majority people were buyers during dark days of March 20 when markets were falling like a stone. And today they are rejoicing. Despite this correction, they are sitting on healthy double-digit return. So my feeling is that the experienced money will use this correction as an opportunity to buy, albeit in a calibrated manner, not in an aggressive manner. There will be undoubtedly some inexperienced money, mainly coming on direct platform, looking at last 6 months' performance. When they see negative return, they are likely to stop their flows or redeem money. My recommendation has always been that you have to follow your asset allocation model. And like for your physical health, you consult a doctor and don't go to the chemist directly. Same way for your financial health, you need to consult your advisor or mutual fund distributor. Don't invest looking at last 6 months performance. Any direct plan on a platform, that's not going to give you financial freedom.
No, fair enough. But just the point on, so what you're saying that has been at a net level, there's been some slowdown in February. And what would the industry-wide cash position be like? I mean, there were some funds that were running as much as 18-20% cash. I'm guessing a lot of that has been deployed in this brutal February sell-off. Any estimates of overall how much firepower are you folks still sitting on?
So in the month of January, the average cash balance, and I'm just rounding off number, was about 5%. That's roughly about 1,75,000 crore. The asset allocation fund and balance advantage fund, which have ability to take higher equity as market becomes cheap or valuation-wise attractive, that's roughly about 1 lakh crore. So there is about 2,75,000 crore worth of potential firepower within domestic mutual fund industry. Obviously, it does not take into account SIP flows and lump sum flows, which can continue to come.
All right. Hi, Nilesh. Good morning and good to see you. Nilesh, first of all, you need to compliment you. I recall more than a year or so ago, you all stopped taking inflows, SIP inflows in small caps, and that worked well. My question to you is, do you think that, small caps now, they've seen a fair bit of correction? Will you all be revisiting that? So if you could give us a brief idea on that. And also, we've got a new SEBI chief, and I believe that there is feedback that, is being taken from various market participants. What would your top expectations be to the new SEBI chief?
So one, SEBI has always an open door policy, and I'm sure under new SEBI chief, the same will continue. Undoubtedly, they gather inputs from all the investors, not just domestic, but also global. Very recently at Kotak Institutional Equity Conference, we had brought certain global investors to India, and SEBI was very kind enough to meet them in their offices. When we tell these investors that we'll take you to our regulator, they are surprised because that doesn't often happen in their market. And the transparency with which our regulators interact with them, the transparency with which their questions and queries are answered, and some of the myths in their mind which are removed are truly spectacular. There's a lot of misconception about registration process in FPI. But when they look at the data, interact with SEBI, and the willingness which SEBI officials are providing to process their application, it does leave very, very good impression with the investors. I'm sure under new SEBI chief, this trend will continue. We'll continue to give our inputs for the development of the market.
Okay. Nilesh, to round things off, and you've seen so many of these cycles, and you've seen bigger crises, including the global financial crisis, right? If I were to ask you, what are the signs? One sign would be FPI buying returns. That's one clear sign. But through the years, in the last 30, 40 years of your stock market career, what are the indicators or signs that you look for and that clearly tell you that, this is the bottom's almost here?
So, Surbhi, I'll answer this in a lighter vein first. When I go to party and no one recognizes me, no one comes nearer to me, everyone runs away from me, I know that is the bottom of the market. Now, no one is interested in stock market. That's the time to go and buy. On a serious note, as you very correctly mentioned, FPI stopping.
So right now what happens when you go to parties? Are half the people coming to you, or is the whole crowd still coming to you? Where are we on the party circuit? If there are still parties happening.
You have still invited me on CNBC, so my guess is that party is, just beginning. It's not ending.
Okay, but yeah, you were saying on a serious note, yeah.
FPI stopping their aggressive selling or turning buying will be one opportunity. The second could be the valuation. Finally, at the end of the day, stocks are slave of earning power. Value is what you get and price is what you pay. So if the valuation becomes cheap, let's say 14 times forward, 15 times forward, then certainly I believe markets will bottom out. The third could be geopolitical side. As of today, we are in a situation where America is putting tariff, their markets are going down, and everyone else's market going down. It's a lose-lose trade rather than win-win trade. If there is reversal in those geopolitical scenario, where from lose-lose we go towards win-win kind of situation, again market will bottom out. Again, my limited point is that there's no way we can predict where the markets will bottom out. All we know, when the markets are cheap, we should be a buyer. When markets are expensive, we should be a seller. That is the dharma of asset allocation.
नीलेश भाई, ये बड़ा टफ टेस्ट दिया है आपने. जब आप कहीं पार्टी में जाएंगे लोग पहचानेंगे नहीं, ये बहुत मुश्किल है. तो मतलब आई थिंक बहुत रुकना पड़ेगा फिर भी. Thank you very much for that. I really appreciate your time and good speaking with you there as far as markets are concerned. 100 points lower, so there is a bit of a recovery. That 22,000 is back on the board, but it's still 100 points lower. But the important thing is, and I was saying earlier as well, there was no volume on the downside yesterday. Look at what has happened to market breadth. Market breadth has now converged almost 1:1. It was almost 3:1, 4:1 in about 5-10 minutes back. And now we got about 1150 stocks which are higher and about 1270 stocks which are lower. There you go. It's almost now equal in that sense. And lots of those stocks we were talking about, Narayana was down 5-6%, is down 1%. Many of those stocks have recovered in the intervening last 10-15 minutes or so. And a lot of stocks coming up. I mean, it was all very small on the upside, but you got 3, 4, 5%, at least 10 names with decent sized volumes now, which we'll address in just a bit, which have got volumes and which have got decent price gains as well. So broader market looking much better from what the start really showed us. Guys.
Okay, all right. Well, more mature reaction is what you've seen in our markets. I think a couple of factors that played out. One is that we had already corrected, crude oil prices lower as well, a bit of a tailwind. So it's actually a pretty good looking screen, going by what we saw in the global backdrop. But let's focus on a couple of other stocks then. Bajaj Auto, that's the management next on our radar. Remember, the stock is trading closer to around a 52-week low. We have Mr. Rakesh Sharma, the Executive Director at Bajaj Auto, who joins us on the show. Hi, Mr. Sharma. Good morning, and thanks a lot for joining in. Well, let's focus on the domestic part of the business first. Are we on track to achieve the industry growth of around 6 to around 8% in quarter 4? You had briefly talked about earlier. In the first 2 months of the quarter, I think the growth is a little more than 4%. So your take on that?
Good morning. Yes, I think despite the turbulence, the little speed breaker we have hit in February, the industry does seem to should close the financial year with a 6 to 8% kind of, there's only one more month left now, which is this month. But it should come in at 6 to 8%, which is what we had said actually even at the start of the financial year. But having said that, the year has been characterized, and I think this is a sign of our times, that there have been wild swings in growth rates from quarter to quarter. So, like the first quarter was double-digit growth, I think early teens, and then quarter 2 sank to 1 or 2% growth for the industry. Then quarter 3 again went to 11-12% growth for the industry, in which October played a very important role. And quarter 4 expectedly was seeming to be lower even at the outset. And therefore, it's just the nature of the way the business is flowing now that it is very difficult to extrapolate from any one month, and it's better to take a long shot. And that long shot view suggests that the industry is at about 6% growth fundamentally.
Okay, all right. So you're sticking to that earlier guidance. Could you tell us about your market share in the 125cc segment? We believe that there is some competition out there as well. So if you could give us what is the updated market share according to the numbers that you have?
So there is competition in all the segments, and but the 125cc plus segment, which is 125 upwards, not just 125, that is the area of our focus. And our market share has been hovering in the region of 21 to 23% now for the last, I would say, 4 or 5 months. And why I give this band always is because, in the end, it's a bit of a derived market share. We tend to look at retail market share, but what is published is overall. So based on historical trends, we derive competitive numbers, and that suggests that we are operating in the zone of 21 to 23%, which is a number 2 spot, a few percentage points still behind the leader in that segment.
Oh, okay, got it. Mr. Sharma, morning, sir. Just to go back to that point of growth, and you're saying industry-wide, I think 6% is a number that we should work with. I mean, somewhere this is getting a little confusing because you have the big stimulus coming in from the government in the form of the income tax cut and other events like in the northern part of the country, like this Mahakumbh. But despite a lot of these positives, the numbers have been month on month, the numbers have been, they've been dropping off. They've been anemic. An analyst that we were speaking to yesterday was telling us that the lack of adequate financing perhaps is now beginning to hurt. Is that the sense that you're also picking up? Why is it that the numbers are not firing as well as they were till the first half of this year?
Yeah, your observation is very right, because if we look at it very simplistically, it is difficult to understand the sudden downturn which almost every segment has faced. Whether you look at ICE scooters, ICE motorcycles, electric vehicles, they're all negative single digit, So February has been a little bit of a surprising point. But that's why I prefaced my comments about, the nature of growth. What we are finding since the last 2-3 years, that it telescopes within a few weeks, and then the peaks and troughs are very, very sharp. Fundamentals wise, I, agree with you that the road network is expanding. There has been an overall positive budget. The things like GST cut immediately impact the pocket, but things like income tax cuts are not easily apparent, and the net is much smaller. They affect a much smaller number of people. On your comment on financing, I won't entirely agree from at least the ground reports which we are getting that financiers who have been prudent from the beginning are continuing with the same policy. So we have not seen a pulling back. But we have, yes, noticed with some financiers that they've pulled back. But that too, I feel in certain pockets, what has happened is, and there I think SEBI also made a very correct observation, there are a lot of being small loans and which have been deployed in the stock market is what the speculation is. And then there is this halo, this wealth effect which takes place when the markets are down. So that was coming exactly. Yeah, but I won't say that it is an all-pervasive thing. It is there in certain urban pockets. But fundamentally, I feel for the industry, it is the fundamental drivers are intact, and it is the consumer behavior which gets into a consumption cycle when it believes it is the best thing to get into.
So financing, sir, is not a concern, right? I'm just clarifying that to place it on the table for our understanding. That fundamentally, there's no, curb in financing that's leading to this. It's other factors, sentiment, etc., like you're describing, right?
Absolutely. We have a 100% captive finance company. And I can tell you that between October and now, nothing has really changed in terms of changing the risk algorithm and stuff like that. I mean, we have to exercise prudence at all times, and that's being done.
Right. Mr. Sharma, good morning. You took the words out of my mouth. I was coming to that. I've been asking real estate companies and others as well, four-wheeler companies, whether this is a powerful thing, right? You feel poorer as you see your portfolio every day mark to market, and it's worth lesser than it was yesterday and the day before yesterday and the day before that. And it's all behavior at the end of the day, consumer behavior. How much of that is responsible for, and do you think it's yet to play out and it'll have this lingering impact if markets stay like this for some time? And what part of the portfolio, the premium end?
No, your observation is right. I agree with you. At the end of the day, there is so much of sentiment involved, particularly when you come to products which have got a discretionary purchase, like holidays or motorcycles for that matter. When there are headwinds, people tend to postpone these purchases or downtrade to some extent. So I would agree with you. My only limited point is that this wealth effect aspect driven from the stock market is not an all-pervasive thing. We have seen rural incomes go. So we made a comment about the Mahakumbh, etc. We feel that the Mahakumbh factor is going to play out. I mean, it's just concluded, right? These factors will play out. And I think, I personally feel that in the oncoming mini season, which begins by end of March and continues this time right through April, May, June in the north, which is the marriage season, you will see a reversal of trend, because that is again the nature of the beast. People start to hold back. And let me tell you, a lot of this consumer behavior is being shaped by some of the mega companies in e-commerce, these Black Friday type of sales, etc. There is slowly a psyche is evolving, which controls the discretionary purchase and times it with the best periods in the year. We are seeing that phenomena play out. And that's why I'm saying that this minus in February is not alarming as yet. Yeah, if it repeats over 2 or 3 months, then one would sit up. But otherwise, I would expect this negative to reverse into a positive growth, perhaps in the next quarter, beginning end of March to entire quarter one. That is what my expectation would be.
Okay, and so final question on this whole tariff business. While a lot of the export markets that you operated in, there's no issues over there, whether it's Latin America or Africa. But as you're watching this from the sidelines, all this play out, do you see either challenges or maybe even opportunities because of the cross flow with, counter tariffs from one country to the other? Basically, this whole US tariff business, does it impact you in any way, positively or negatively, either for end products or even for the supply chains?
Well, not tariffs in particular, because large parts of our business are in the emerging markets, which are not in the radar screen and in the crossfire. But the consequent impact of all this discussion, the seeming reversal of globalization, is definitely causing, again, some instability in emerging market currencies. And that leads to, that devaluation leads to inflation in the local markets. Of course, in another way, the devaluation of the rupee is helpful for our bottom line. But on the other side of the coin, our retail markets experience inflation, and that sort of impacts demand. But on the positive side of all this, I think I see an opportunity for a China plus one kind of a story emerging for India, where there are a lot of companies now wanting to source, wanting to spread the base, certainly into countries, capable countries like India. I would say we missed the first bus, where people like Bangladesh, even Bangladesh and Vietnam harnessed the wind. But I think we've got handed a second opportunity for this China plus one kind of a move. And that could augur well for our manufacturing.
All right, Mr. Sharma, we'll wrap up on that very optimistic note, and I hope it does play out for the industry. Thank you very much for explaining all of that and sharing those insights with our viewers here on CNBC TV18. Till the next time then. Well, 70 points lower on the Nifty. There is a recovery afoot. And forget the Nifty. Look at the broader market. It's completely turned around from 4:1 declines to advances. It's now 2:1 advances to decline. The NSE market breadth, the advanced decline will come up, and that is essentially the signs of a recovering kind of market. 1,600 up, 800 lower, 800, almost 900 lower. And we have to mention these stocks. I know we have another management waiting, but look at just a few of these. KRN is the top volume-led gainer right now. Stocks at about 928. KRN Energy. You've got Schaeffler, which is up 4%. It's got large volumes. TD Power Systems is up 8%, 329. There is Garden Reach, which is up 6%. Stocks at about 1287. Zentech is up 5.5%. These were all stocks not in the mix in the morning when we looked at least for the first 15-20 minutes or so. Zentech, that is, 1,097 on Zentech. Bluejet is up 3%. Let's have Bluejet up, please. Praj Industries is up about 6.5%. Jyoti CNC is up 10.5%, 11%. Stocks at about 855 at this stage. Okay. There you go. That's Bluejet, Praj, Jyoti CNC. Look at something like a SW Solar, which is surging. It was flat 5 minutes back. It's up 5.5%. SW Solar. Look at GHCL, which is up 7%. Gravita is up 5%. Taj GVK is up 4%. Newland Laboratories is up 5.5%. Suddenly, there's like a burst of activity in mid caps and small caps, all in the last 7-10 minutes or so, less than 10 minutes actually, because this is all fairly new, and there's more, but you get the broad gist. So broader markets, very solid recovery coming through. We take a break. We'll have the management of Jupiter Wagons joining us, Jupiter Group joining us to talk about the business and order book picture. Stay tuned.
Welcome back. Well, let's talk about Jupiter Wagons. Their subsidiaries have been in the news lately. Jupiter Electric Mobility will launch its first commercial EV. Another subsidiary has received a 255 crore order for wheel sets, and the company also has a big capacity expansion plan. To talk about all of this development, we're joined by Mr. Vivek Loya, the managing director at the company. Hi, Vivek. Good morning, and thanks a lot for joining in. Well, let's focus on the first point. Jupiter Wagons will be launching the first commercial EV, which is Jupiter Electric Mobility TEZ in Indore. Tell us about this development, the rationale, revenue potential, and how do you see things pan out?
Yeah, so good morning and thank you for having me on the channel. So this has been in the works, the launch of the car has been in the works for the last 3 years. The whole idea was that we were already working with the major OEMs, mainly Tata Motors and Volvo. We were their biggest manufacturers for load bodies and chassis. So the entire idea was that how do we complement the entire infrastructure. So that was the genesis of the launch of our eLCV segment. So finally, yesterday we have launched the vehicle. It is a 1-ton vehicle with the maximum range right now in its class. On road, it is giving a range of about 190 kilometers, and it's got a fast charge where you can charge the vehicle in 1 hour. The payload capacity is also the highest in the segment. We have got a very strong positive feedback from the market. The vehicle will start rolling out to our dealers in this month itself. And towards the end of the year, we plan to also launch a 2-ton as well as the 3-ton payload variant. So this basically covers our entire last mile and mid mile eLCV segment. And that is our key focus.
All right, Vivek, just to reconfirm, in this particular vertical, you have around 75% of the company, right? Of this electric mobility. Got it. And going by all the launches that you said, what kind of revenue potential can you throw up? FY26, FY27, potential margins as well out there, and your peak operational capacity?
So right now for the vehicle business, our capacity is at about 8,000 vehicles. And FY26 definitely, again, to give specific numbers, since we've just entered the segment, to give different numbers, it's very difficult. Yeah, if you look at the segment, currently the eLCV segment in India, typically about anything between 400 to 500,000 vehicles are sold in this segment. And by all estimates, in the next 2-3 years, you're looking at least a 25% conversion from ICE engine to electric engine, because there is a distinct economic advantage of using an electric vehicle. And especially in the metro markets, you're seeing that the charging infra is developing rapidly. So that is giving a huge boost to the segment. So we expect that in the next 2-3 years, this will be close to 100,000 plus vehicle market. And idea is to be ready with the entire bouquet so that we can aggressively tap this segment. Besides this, again, another key in terms of the subsidiary, the key focus for us is our wheel business, where we are undergoing a massive capacity expansion. We'll be investing close to about 2,500 crores in the next 2 years. We are setting, besides the existing facility in Aurangabad, we are setting up a greenfield facility in Orissa, where we will take the capacity up to 100,000 wheel sets, and of which close to about 50% of the capacity will be exported to the European market, and mainly to our partners, Tata Wagonka, who are the biggest manufacturers of rolling stock currently in the European market. So they have a sizable demand for wheel sets. So this is basically going to complement their entire rolling stock business.
Let's talk about some overall targets as well. I mean, I think the original target was doubling revenues to about 600 crores. So as we're almost, about to wind down the year, in terms of top line, where do you think you'll end the year? And what is the CAGR growth that you'll target for, say, the next 1 to 2 years?
So, if you look at the wheel business specifically, 600 crores which you are talking about is the target for FY26. This year we are going to grow by close to in FY24 we did a number of about 100 crores in this business, which in this year we will take it up to 300 crores. Right now the only limitation for us is the capacity. So in Aurangabad, from now 13,000 wheel sets, we are ramping it up to about 20,000 wheel sets. In the next 4 to 5 months, that capacity will be online. So that will, the 600 crore revenue target, basically that will help catapult us to that target. And once the Orissa capacity comes in, you're looking at numbers of close to anything between 2,500 crores to 3,000 crores of revenue just from the wheel business itself.
And which year would that be, when Odisha is fully operational, commercialized?
No, it'll 26 end is when the axle line is going to start, and 27 is when it'll be completely commercialized.
Okay. All right. Okay, we will leave it on that note. Thank you very much for joining in and giving us a sense on the business. That's the management at Jupiter Wagons. Back to the screen now, and what a brave, pullback by the bulls, you'd have to say, from a decline of 2% on the Midcap index. Now it's a recovery of 0.5%. Beautiful exchange on the advanced decline ratio as well. It's a phenomenal screen to be looking at. So good to get Mitesh in. Mitesh, what's the sense? What are the trades now?
So I think should be the first signs of a reversal, at least from the banking names. Though I think it's still to be confirmed. I would want to see the bank Nifty get past 48,350, 400 zones, and then we can look at 48,600, possibly 48,900 to about 49,000. I think if that plays out, then I think we'll have a good bounce back, and that will weigh in on the Nifty as well. I think what was the fear in the morning that the bank Nifty could break down. It hasn't done that because we didn't sustain below 48,000, and now I think we are trying to give a reversal on the hourly charts, and my figure is about 48,400. So about that, I would want to take some long positions on the bank Nifty with a 120, 140 point kind of a stop loss, and play out for 400, 500 point kinds of rally from there. Having said that, on the stock side, Bandhan Bank is something which has caught my eye. It did well in the after the morning decline and is giving a reversal. So buy here with a stop at 140. The first target on the upside should be around 147, though I suspect we are looking at about 153, 154 on the upside. And the other stock is Indigo, which it actually didn't decline also much. This has been clearly showing outperformance, and today the intraday charts are also positive. So Indigo is a buy with a stop below 44.80 for targets of 46.20.
Okay, all right, Mitesh, thanks a lot for that. In fact, Interglobe is one of the stocks on the radar because crude oil prices have cooled off, which could have a bearing on the ATF prices as well. So that's one big stock that's recovered from the day's low, and the OMCs as well. Falling crude is a positive for them. It could help them in terms of their EBITDA numbers as well. So you pull up HPCL, BPCL and IOC. all of them from the low point of the day have seen a big recovery. Not ONGC, but the OMCs is what we're talking about, because they gain when crude oil prices move down, and all of them have seen a big recovery from the low point of the day.
All right. No, I mean, I think it's a solid bounce coming through on the broader markets, and market breadth is improving even more as things stand right now. Let's talk about IT services as a space. Now, Sandeep Agarwal is with us, fund manager at Sovilo Investment Managers. Sandeep, good morning. Good to have you here. Prashant on this side. Now, IT 2 weeks back, it was looking like it was not correcting. It was down about 8% from the highs. Last 2 weeks changed all of that. It lost another 10%. So we're down about 18-19% from the highs for the IT index itself. The other question more recently, of course, is if the US market starts to come off and growth indicators, etc., are moderating, what will it mean for the market as such? Specifically, what will it mean for the IT services sector? So just start with that basic point. We've had very strong US economy and markets for a few years. And for the first time, we are starting to hear that maybe things are going to go in the other direction for a while, maybe temporary, we don't know. How does it affect IT services companies from here, where they are already? Sandeep. You'll have to unmute yourself, Sandeep.
Yeah, hi, good morning, and thanks for having me on the show. So Prashant, if you recollect our earlier conversation just 18-20 months back, when there was gloom and doom in the industry, we were extremely constructive and we were very positive. Last 5-6 months back, if you see all my interactions, I have been saying that, all the positives are baked in, but any kind of negative which can come, and if it at all comes, then we will be in a difficult spot. Now, Indian IT has a more than 95% market share globally in the outsourcing part, if you exclude the BPO piece. So we are very strongly positioned when it comes to execution at a reasonable price. But remember, when US economy was doing well, we were hurt very badly because of the disruption which was happening on the AI side. Because whenever disruption happens, the biggest task which Indian IT companies have, they have to, train their whole workforce into that new technology. And by the time when we are 2/3 in that journey of training, we are now seeing early signs of some weakness in the US economy. So, because Indian IT is priced to perfection and one of the cash throwing sector, no one leaves these stocks easily. And there are gaps in 2 or 3 years period of 2-3 months when you get them dirt cheap. And that gap, I think 18-20 months back was there. Now, I think, large part of correction has happened, but I still believe there is some more correction which will happen. The primary reason of saying this is that, no negative news from Trump at least has come yet on the sector. And Trump being Trump, you cannot take him for granted that, he won't do anything in such a big exporting sector. You remember 2014-15, all these localization things came and he enforced that we have more than 50% local employees and all, and that wiped out the margins of the Indian IT companies because local employees are hard to get and very expensive. So nothing can change that. Although, I can tell you that there is no one who can execute at this price in the US, and ultimately the US consumer will suffer very badly if any harsh step is taken on Indian IT. But having said so, politics being politics, you cannot take a call on either side.
You're talking about making it more expensive, sort of tougher to hire Indian workers. I mean, on that side, right? On HR side. You're not talking about a tax on services or anything in that sense.
I don't think it will be tax or services, but it will be more like, he may put in some more condition that you have to hire more local employees. And that becomes very difficult because it is in that market, employees are not available. So if you have to hire more, those few number of employees are chased by more number of employees. So the salaries and the outflows start going up, putting a dent on the margin. So the cost of doing business can go up. That is all I'm trying to say.
Okay. All right. Sandeep, good morning and thanks a lot for joining in. Well, FY26 growth forecasts are mid to high single-digit growth. The recovery, though, has been gradual. Do you think we get back to, say, double-digit growth from FY27 onwards?
I think so, because, in FY26, what will happen, all your training of AI workforce will be broadly over. So after that, we will get some benefits. So low double-digit growth or high single-digit growth is something which FY27 can obviously deliver. But with similar margins. So in that case, what multiple you assign is a very important question. I think the large names like TCS, Techem, and HCL, Infosys, Wipro, they are broadly corrected and the time correction is also done. So I think some money could be there. But some of the names still are very expensive in the mid-cap space where, we have little less comfort and we believe if cost of doing business goes up, then there is some risk.
But so you're saying there's some more correction ahead, perhaps in large cap IT names. And then the basic question, Sandeep, I mean, even if someone decides to buy IT, it'll probably be for other reasons, for instance, cash, safe haven, etc. In terms of growth, can we hope to buy anything more than 5-6% growth or 4-5% growth in these companies next 2 years, say? Will the growth numbers look the same, or do you see some improvement?
No, I think FY27 will be better than FY26 by 2 to 3% at least.
Which means how much growth in FY27?
So around 8 to 12%, depending on the size of the company, is what I see in 27, but not in 26. In 26, I am more like 6 to 8.
Okay, but that's good. 6 to 8% growth in 26, maybe 12% in FY27. Don't remember the last time we were in double-digit growth. So then leave us with some top picks. If someone has that at least 1 year time horizon, if not longer, then what would be your top picks that you would perhaps be convinced on?
So we run a PMS. I will not give stock specific name, but I will give you a flavor. So, in the large cap, there are few stocks which are now reasonably priced at 16-17 times 1 year forward. Those are the stocks which you can start looking at. And in the mid cap, other than the ER&D space, if you are getting something at 18 to 20 times, so PEG ratio of 1.25, 1.5 is something we can start looking at. And in ER&D, you have to give obviously minimum 2 times PEG ratio, because that is a space which will do more than IT services growth for next decade. So you will have to pay a higher premium there. So we clearly see ER&D as a very good play for a longer term if we get at a right price. And within the mid cap and large cap on the IT services, we will be willing to give around 1 to 1.25 PEG ratio. And whenever stocks are coming in that range, it is an attractive level in my view.
All right, Sandeep, we'll leave it there. A shorter chat today, but very, very useful in these volatile times, and gives us a broad idea about how to think about the space. Thank you. We take a break. We're back with Manisha on the other side. Commodities in focus.
Welcome back. So the Indian equity screen is trying to recover. It's not looking as bad as the dire morning. Let's find out what's happening in commodities. Manisha's with us in the studios. It's all rock and roll, isn't it? Particularly in those Bitcoins and Solana and whatnot. But you tell us, Manisha, what's the latest?
Well, I'm looking at all of those markets right now because, you couldn't choose anything. Everything really seems to be looking at off-risk appetite in these markets. And the broader market sense really seems to be taking a hit because of that. And today is yet another day. But you rightly said it's not so sharp, not so deep, and not so bad today. But the pain just about continues as markets are looking at tariffs and then this conversation about retaliatory tariffs as well, which seems to be weighing in. I just want to put some numbers in and explain. Well, US as of now has said that they're looking at 25% tariffs on Canada and Mexico, and that 10% tariff on China will go up to 20%. But if you look at those numbers, well, US imports worth nearly $900 billion from both of these countries. And when you look at both of these countries like Mexico and Canada as well, the export numbers that go to the US are really big. So it is really going to be impacting all of these countries there. So 83% of all Mexico exports happen to US and 78% of all exports from Canada happen to US. So those are big numbers that we're talking about. And this is going to be bothering broader markets as well. Well, US is looking at higher tariffs. And I also want to talk about reciprocal tariffs because that is a statement that also has come in from the US President Trump. He says that reciprocal tariffs will take effect from 2nd of April. So we're looking at tariffs right now. Retaliatory tariffs will come in from other countries and reciprocal tariffs from US will take effect on 2nd. So this is not really ending in any time soon. We already have seen statements coming from Canada announcing retaliatory tariffs, which will come in effect from today when the market opens. The second statement comes in from China, which has rejected US tariffs, saying that they will take countermeasures as well. And we have seen that impact come into the markets. Crude, for example, this is a third straight year that we are trading in negative for the crude oil prices, down by nearly 6% for this year until now. Overnight, we saw 2% of decline, and these prices really are a 12-week lows that we're looking at. The U.S. crude prices are now just about holding $68 a barrel there. The other factor that's bothering crude really is OPEC statement saying that they will increase output in the month of April. They really seem to have written that bullet that US has been given them. Apart from that, the US and Russia conversation also perhaps could give some relief on sanctions to Russia. Russia, remember, is the third largest oil producer after US and Saudi Arabia. And if we are looking at more Russian oil coming into the market, that also seems to be weighing in. Base metals should come in on your screen because we've seen a decline on that as well. On a week-on-week basis, almost every metal is trading in the negative side. The biggest declines coming in for iron ore, trading at a 6-week lows, and the steel prices trading at a 3-month lows as well. The U.S. consumer sentiment for the month of January declined for the first time in 2 years. That seems to be bothering as well. And yes, I also want to talk about crypto markets because after US signed that notification about including many of those cryptocurrencies in their strategic reserve, we saw the prices run up quite strongly, but not anymore. The last 24 hours really have been quite harsh. So 10% down on Bitcoin right now, 15% down on Ether, 20% down on Solana. And you have declines coming in for many of these cryptocurrencies to the tune of 30 to 45% as well in the last 24 hours there. But there's important data coming in as well. You have ADP employment numbers that come in on Wednesday, and then you have US non-farm payroll data that comes in on Friday. So this continues to be a very, very active week in that sense.
All right, Manisha, thank you very much for that. I'm wondering, Surbhi and Manisha, what are tariffs when you impose tariffs and there are the other country imposes tariffs? They're called reciprocal tariffs.
Or retaliatory. You can choose whichever word
and
sounds
then
better.
If the first country imposes tariffs in response to the retaliatory tariffs, what are those called?
Dual retaliatory. I don't know. I'll think it up in the break. It's called a tariff war, to keep it simple. Global trade war.
Okay, all right. Well, Manisha, thank you very much for that. We'll take a quick commercial break here. We're going to come back, but we're going to focus on the local economy. And we'll talk about NBFCs with Jairam Sridharan of Pyramid Enterprises. He's Lata's guest on the other side. Stay tuned. Interesting chat coming up.
Welcome back. We have spoken all morning about Trump's and tariffs in the US economy, but the market seems to have just recovered from the day's low. So let us now revert to one domestic issue which gave us much relief in early February. The Reserve Bank of India cut risk weights on bank loans to NBFCs and MFIs from 125% to 100%. This was probably because since November 2023, when the risk weights were raised, bank loans to NBFCs have fallen from 30% YOY to 7% YOY as of December. But the Reserve Bank has not cut the risk weight on unsecured loans. So have unsecured loans continued to be a pain point and are not yet out of danger? Also, how has life improved for NBFCs more generally? For all these, I'm joined by Jairam Sridharan, the Managing Director of Piramal Capital and Housing Finance. Good evening to you, Jairam, and thank you very much. Jairam is actually in the United States now and has stayed up for me. Thank you very much, Jairam.
Thank you. It's always a pleasure to be with you.
Well, for starters, you were the one who told us about unsecured loans actually a good 2 years ago. And actually, the Reserve Bank followed, I think, about 3 months later. So I wanted to ask you first about unsecured loans. Your own Piramal balance sheet is quite good in the sense your NS3, GS3, that is gross NPAs and net NPAs are actually declined by a few basis points in your Q3 results. But what is your view of the sector? Are unsecured loans going to continue to give us bad news?
Yeah, the short answer to that is yes, unfortunately. The way the year has gone so far, the financial year, when it started, we were in absolutely the best of health, right? The sector had an absolutely rocking quarter, Q4 last year. But then suddenly, after March, when April happened, things seemed to have deteriorated quite suddenly. Like we didn't quite know what was going on. Operational metrics and unsecured credit were bad in April, and then worse in May, and then even worse in June. And the story just continued all the way through November, almost till December. So there has been many months of deterioration in unsecured credit, and it has been more severe in some product categories like microfinance and a little bit in small business unsecured credit, and a little bit less intense in salaried businesses, in larger ticket businesses, etc. So it has not been the same everywhere. It has been mixed. However, where we are today is that the pain seems to have, from an operating metrics perspective, things have stopped deteriorating. That's pretty much the most that can be said about it. Things are not getting worse anymore. It's been 3-4 months of relative calm, 3 months of relative calm, and things haven't gotten worse. However, by no means can it be said that things are getting better. So it is.
To speak on the I take your point. To speak on the side of things getting better, the government has really started spending well. Up until October, there was practically a drought of government spending, and then in December, it was a 95% increase over a year ago level, their capex spending. January, we again have the data, 50% more. So do you think now loan growth can improve simply because, there is more economic activity? After all, the Q3 GDP came out so much better than Q2. So is there a loan growth possibility?
I think so. I think the growth side of the story had also weakened, unfortunately, over the last 9 months, when the growth rate of overall lending at the sectoral level, which started the year at 20%, ended the year at, ended December at less than 10% or around 10%. So growth rates have really, really slowed. But now you're absolutely right, Lata, in saying that the government spending makes a big difference. And as the government has started spending, projects have really started taking off. We can see that, that excitement come through. We can see small businesses start to spend a little bit more. And my guess is that you will start seeing loan growth pick up a little bit more from the low levels where it has been over the last couple of months.
Okay, you're in a vantage position to tell us about the real estate cycle. While it has been one of the better factors in the economy, has the cycle been impacted by the wealth effect? After all, we have seen trillions of rupees melt away in market cap. So what's the state of the real estate sector?
Very often when we speak about real estate, we get too carried away by, few real estate players who are listed, right? And their numbers and their public pronouncements, etc. But remember that real estate is a very, very, very fragmented industry. And to get a real sense of what's going on in the sector, you got to look at the entire country, small towns, big towns, everything together. The story there, Lata, is that since COVID, the recovery of the sector has been decidedly K-shaped. The higher end, the more luxury end, has done spectacularly well. Any project that comes out today, which is more than 2 crores, 3 crores ticket size, is just sells like hotcakes, right? In fact, in Mumbai, there are multiple projects with double-digit crores as the average ticket size, and you can't find a spot there. However, you look at the 25 lakhs and below space, and stuff is not selling at all. Things are very, very slow. So it's a very two-paced market right now. The top end is doing extremely well, and the bottom end is actually not doing well at all. And if you look, for example, at the lending business, at the less than 25 lakh loans for housing, you will see that the growth there is negative at the industry level. So that shows you that there is no the small low end is struggling. The guy in the semi-urban and rural markets is really struggling.
Okay. What about then? Let me bring it down to Piramal itself. Piramal Finance, the disbursements in Q3 were 8.7% higher from YOY levels. So, and you of course serve used cars, business loans, salaried. How would your loan growth look like? We've been blessed. We've continued to have year-on-year growth rates upwards of 30%, 40% actually over the last couple of years. And this quarter is continuing to look strong. So from an AUM perspective, we've continued to feel very good about the growth rates, and we will continue 30% plus growth rates that we've had. Whether it'll continue in the next year is a little bit harder to say, but right now this quarter is looking very strong. Okay. So in your company, of course, you all are running down your old AUM, what you call 1.0, and building up your new loan book. The old DHL book is being run down. When does that process get completed? When will you be not impacted by higher credit costs, very high credit cost actually, because of that legacy part?
Yeah. So we have guided the market that we will end this financial year, that is March, with less than 10% of our AUM being from the legacy book. We are very much on track for that. We ended last quarter at 13%. We should be below 10% by the, over the next few weeks when March ends. Our hope is that by next year end, this number will be significantly south of 5% of our book, and hence will kind of become irrelevant.
Okay. Has life improved for you after the risk weight decline, and what might that do to margins?
Yeah, it's certainly better. Like it's more than the specific risk weight reduction action itself. It's the signaling that makes so much difference. It's a regulator telling the banks that, hey, lending to NBFCs is not a bad thing. I'm not discouraging you. And I do want NBFCs to participate in building the economy as well. That signal goes a very long way. See, specifically when banks are pricing on the basis of RAROC, or risk-adjusted return on capital, a 25 percentage point reduction or a 30 percentage point reduction in capital or risk weights results in about a 25-ish basis points reduction in price, right? So that's basically what mathematically one would expect. But much more so than that, what I'm really happy about is the signal that the regulator has sent, and hopefully that encourages a lot of lenders to step forward and go ahead with lending to NBFCs as they used to do in the early part of last year.
Okay, let me a quick last question. Also, because it's time I allowed you to retire. You've had a long day. Just wanted to know, what would you guide by way of margins now, And what would you guide by way of loan growth for the full year? I mean, this quarter is almost over. For the full year, do growth prospects look good, considering that the global environment is not very clement now?
Yeah, I think for us, idiosyncratically as a company, like our growth prospects are pretty strong. So I feel very good about where we stand. Our core growth book should comfortably grow at about 20%, and on an overall basis, after accounting for the rundown of the other book, we should comfortably grow about 15%. So I feel reasonably okay on the growth front. On the margin front, the sector, NBFC sector overall, has seen margin compression throughout this year. But I think that margin compression story is largely done. Now that RBI has started the process of rate reduction, that will slowly start expanding margins. And that's the way historically it has happened, is that as RBI reduces repo rates, slowly transmits to sectors like NBFC, and margins start to expand on the other side. That's what I expect to happen in this cycle as well. That should start, I would say, about 4 or 5 months from now as banks start cutting their MCLRs.
Okay, that's good to hear. Jairam, when you're back in India, let's have a longer conversation on the state of the NBFC sector as well. The economy was clearly looking like in a good run, but today's global headlines are casting a bit of a scare. Let's wait and see how things pan out. Thank you very much for staying up for us and for this conversation. As we sign off on Bazaar, the markets have recovered a goodish bit from the morning lows, certainly much better than what the GIFT Nifty was indicating before markets opened. Positive note as we go into a break and invite Chartbusters team.